Good afternoon, everybody. I think we've captured a few of you or a few of the delegates on a bit of a lunch slump. Hopefully their blood sugars will come up to normal. But anyway, welcome. I'm going to talk today a little bit about AI, credit scoring and loan approval process. Just before I get going, a little bit about myself and the company that I work for, Principa. We are operating in we're operating in over 30 countries across the Africa continent, as well into the Middle East as well. We offer consulting, advisory services, analytics, as well as software across the credit life cycle. So anything to do with credit, we pretty much run those services. And we've got a bit of a brag sheet about some of those brands that you may or may not recognize, some big blue chip companies that operate in the region. And myself, I'm going to talk a little bit about AI-driven scoring. In fact, I did my thesis in my MBA, for my MBA last year, in alternative data and how that is driving in a big way the sort of AI, the AI drive in Africa. Okay. All right, I'm just going to jump through that. Okay, so some of you may know, some of you may not know, so please bear with me if you are familiar with credit scoring, but I just want to establish what is credit scoring. So for credit scoring, in one sentence, I think we've got there we go. A credit score is a number that represents the credit risk of a customer or applicant. Okay, so instead of us doing a manual assessment of a customer and saying, well, I think this customer is okay, we actually do an assessment of the customer and we get a number, and that number represents the customer's credit risk. Okay, so if we just have a look at this little table here, an example very quickly, we've got age, marital status, number of dependents, residential status, etc., etc. So we've got what we call the characteristics of the customer who's making his or her application. They may be a consumer, they may be a proprietor of a small or micro enterprise, and yes, they fill out their application form. Their age, 36, their marital status, single, number of dependents, 1, etc., etc. And you, as the credit manager, have to go through this application form and decide whether the information is positive or negative. So 36, yeah, that's good. He's perhaps quite mature. Single, maybe we don't like that. Number of dependents, 1, that's good. It's not too many dependents. Residential status, owner, very good, that's great. Time of the address, 4 years, that's pretty good. They're not moving around. And occupation, self-employed, maybe a little bit risky there. Time of employment is 8 months, and that's a little bit short as well, so we'll say negative. So you see positive, positive, negative, negative. If you add them all up, you'll see there's more positives than negatives, and as a result, we wish to accept the customer. But we don't know anything about the odds of repayment of that customer. So this is where credit scoring comes in. Instead of positives and negatives, we actually score the customer and we give points, 46 points, 20 points, 38 points, 45 points. These are derived mathematically beforehand, and we determine the customer's credit risk. In this case, they get a score, total score of 227, and we believe from before that 227 is an acceptable credit profile, and therefore we'll accept that customer. And now we actually do know the odds of repayment. It's 7-1 in this case, and that is acceptable. An acceptable risk is acceptable in terms of our risk appetite. So, okay, I'll skip the. There we go. So in terms of a mini application scorecard, what does it look like? Here we go, number of dependents. You've got on the left your attributes, 0, 1, 2 plus, and on the right you've got your weights, 30 points, 34 points, and 38 points. And then applicant age, we've got little age bands, and we've got their weights. So you get the idea that a customer will be scored under each of these categories, and they will be getting a weight for each of these categories according to their attribute. So if the person had one dependent, they get a score of 34. If they were an age of 35, they would get a score of 38 there. And in their residential status, they're an owner, they would get a score of 45. And what we would do is add up all of those scores, and we'll get a total score. The reality is scorecards are generally a lot bigger. We normally have about 15 characteristics. Here is only 3, but this was just for illustrative purposes. Okay, so then what you do is you got your score, and in this case, if you look down bottom left, you'll see there's a range from 0 to 300. And what we determine on that range is where we want to put our cutoff. So in this case, the cutoff is about 75. Below the cutoff, we will decline. Those are too high risk. And above the cutoff, we will accept. And then we basically know that we should be getting good profile customers coming through with this sort of credit policy. And on the right, those 2 graphs represents the distribution of your bads and your goods across the score. And you see the bad score lower than your goods. The 2 graphs show 2 scorecards of different strengths. The one at the top is a weaker scorecard because the goods and bads are closer together. And the one at the bottom is a stronger scorecard because goods and bads are accepted. Different scorecards have different strengths, and we always are trying to get the strongest scorecard that is stable as well. Okay, so scorecards is kind of where the idea of AI and credit started. AI is quite a broad definition, and that's where we start today. Okay, so let's talk a little bit about digital credits. Okay, so digital lending has enabled several AI-enabled applications, including the following. In fact, we have some exhibitors out today that are showing off their AI tools that they're being used in the origination space. So if we talked about application scoring, I showed you those scores before. We had bureau scoring. We have fraud scoring. That's a very important area, looking at different types of fraud within the business, normally application fraud, but you can also get into transaction fraud. Selfie verification, there's a couple of vendors showing that their selfie verification tools. Alternative data assessments. So we looked earlier that we were looking at scoring using demographic information. That's a demographic scorecard that I showed you, but there are other scorecards using other alternative data that I'm going to talk to you about shortly. Bank statement verification, this is also something going on. I'm not sure what's happening in the Tanzanian market at the moment, but in jurisdictions with open banking, what's happening, people are uploading their bank statements, or they are calling on the banks and getting a download of the customer's bank statement. And from that bank statement, they are extracting, often using OCR technology, key information such as the customer's likely income or incomes and their likely expenses, and utilizing that within an affordability assessment. And they are also looking at utilizing that information for transactional scores as well. And that moves on to the next one, transactional data scoring. And then the last one is chatbots. Through the digital journey, we are finding more and more chatbots coming into play. And these chatbots are becoming more and more intuitive and more user-friendly. I think they're the best and the worst of AI sometimes. Right. I will just jump to the next slide. I'll jump to the next slide to come back to that. All right, so just on some of the scores and how predictive they are, we have on the right-hand side, we have what's called behavioral scoring. That's so left to right is weak to strong in terms of the strength of the scorecard. Bottom to top on the y-axis is your how available that score is. Okay, so the first one, the most strongest scorecard you have in your business is generally your behavioral scorecard. That is a scorecard of an existing customer and relates to how they are behaving in your business. That is a strong scorecard typically, but it's not, you don't have that for every customer. The new customers don't have behavioral scorecards. Then if your country has bureau scores, those are the next strongest. They are typically a Gini of 40 to 50 strength. And then the third strongest one here is psychometric scoring. And I'll talk a little bit more about that. And we've got a booth outside where we can demo psychometric scoring if you're quite inquisitive and you want to know more. And there's other things like mobile data scoring. That's looking at your behavior on your mobile phone. There's geospatial scoring. That's looking at where you live in the country and what is the risk profile of people that like you who live in those areas. And then online behavior, so your online scores as well. And then at the top, we've got demographic scorecard. So psychometric scores are great because they are strong, but also they are 100% available. If you take a psychometric test, you get a psychometric score, like demographic. If you fill out a demographic application form, you will get a demographic score. Okay. Let's see, we go to the okay, just going on to psychometric scoring. So those who are well-versed in banking and lending, generally you will be very familiar with the 5 C's of credit. These are traditionally the 5 areas that we assess a customer on when they apply for a loan, whether it's a consumer, whether it's a small business, or even a larger business. We've got capacity. The customer's capacity to service this loan. We've got the capital. That is what capital they have behind them. And that might also, and then we've got, similar to capital, we've got collateral. So can the customer put down collateral as a guarantee? And then you've got your conditions. What's your terms of business that you want to offer? And the final one is character. Character. In the old days, you'd have local lenders, maybe local banks. The bank manager would know you. You'd dress up in your suit and you'd go and apply for a loan and ask he or she very nicely, and they would maybe offer you a loan. But we don't have that anymore these days. So how do you lend anonymously? How do you deal with the 5th C in credit, the character element? And this is where psychometrics plays a big role. We can use a psychometric test to really understand a customer's traits, their emotional states, their ability to make decisions, and essentially how deceptive they might be. Okay, so just these days we use something called the situation judgmental test in psychometrics, and it's a pictorial test that is done. So it assesses somebody's psychometric profile. What we do is we ask questions, but they're in the form of pictures. There are 10 questions that we ask, and the customer has to choose various pictures that are most relevant to what the question is. There we go. Takes about 5 to 10 minutes to complete. It's gender, race, and age neutral. We find when we look at different genders, male and female, they score exactly the same. So in fact, the female profiles and the male profiles are actually quite similar. They are in terms of score ranges. We've even done some tests along race lines, and we see also race, it's quite common. And then in terms of age, there is a little bit of bias here where older people are better than younger people. So we used different tricks to make sure the person cannot game the test. And there are 10 questions. And Yeah, and it's completed on a mobile device or a computer terminal as well. So I think that's it. Yeah. So what it tests is the following. So this is all alternative scoring. Traits, values, emotions, decision makings, and whether somebody's decisive or not. So if they make a lot of change their mind while they're doing the test, we also pick that up as well. And all of that combined gives you a very good indication of whether somebody is going to repay a loan, a facility, or a policy. Okay, and this is what it looks like. So you've got a picture here. There are actually 9 little blocks, and you see at the top there it says success is. So success is, what does success mean to you? This person thinks that they need to drag 2 of these blocks onto the right. They've dragged 1 already. It says they think being a celebrity is what success is. And perhaps they think the next studying and graduating, that one in the middle there, the blue outfit, is the next one. They would drag that across, and that's how they were determined. So you see very little writing, and they can actually, we find very good take-up amongst various different communities. Okay, you can come and see that from our booth a bit later, but I'm going to move on to machine learning and AI for credit assessment. Okay, so these are themes that are coming out in international banking in a big way. Machine learning, basically what we're talking about are scorecards that are able to retrain themselves very quickly, or you can retrain them very quickly. And there's also AI as well that we'll talk about. So recent focus on advanced analytics models that can be retrained. And the benefits of machine learning models, they often are, we use advanced analytics modeling techniques, and they are actually stronger models than traditional scoring models, but they are sometimes a little bit less stable. But that means that you can adapt to a dynamic environment. So you can actually put a model in when the economy starts to turn, you can adjust very quickly and then deploy very quickly, as opposed to waiting the standard 6 to 12 months to deploy in a banking environment, which is what we often see. The weaknesses, they're less stable, and then there's the whole aspect of explainability, which is a big theme in AI, as well as machine learning. The banks, a lot of banking, central banks require the banks to be able to explain their models. How do they get to the decision of accepting or declining somebody? The old models are very easy to determine, but the new models are can be very, very complicated, and the explainability goes away. So if you start running a model which starts declining a lot more ethnic groups of a certain ethnic group, or say a certain gender, all women perhaps, then the reputational risk to the bank is problematic. So explainability is important, and compliance is important as well. The considerations you have with these models, if you just excuse me, either a lot of people think they are perfectly automated, which means you run them and then they train, and every few days that they change. Our experience is that that's not what they are. They, in fact, are models that you run, deploy, and then when you want to retrain and deploy, that process is very quick. So to give you an idea, a standard scorecard takes 3 months to build. These models take a few days to build, and then and then we have people check the models and then deploy the models. And we check on explainability, we check on the compliance aspect. It's got to go through credit committees, etc., and it's also got to be deployed as well. So we look at things like deploying within a Python environment on an advanced analytics platform. So there's quite a lot of additional requirements to look at when it comes to when it comes to advanced analytics models. So what does the future hold in terms of AI? Just some of our thoughts. We will see more, what we are seeing in the banking world internationally is more adoption of machine learning in credit. We're also seeing more intuition around chatbots, obviously with the likes of ChatGPT out there and other models, the large language models out there and all that. So you can actually determine a customer's intent very easily through the large language models and react accordingly. So you can adapt a customer journey very easily, adapted specifically for that customer by adapting to the answers that they give him to questions. Potentially, this is the sort of holy grail, AI-generated customized credit products. So that's a big thing. And then further adoption of customer verification. Thanks. So customer verification, we're talking about fingerprints, we're talking about facial recognition. That will be more and more a thing going forward, and more banks adopting that. And yeah, digital bank statement validation, as I said earlier before, not only verifying income expenses, but also generating scores on transactions that are also self-learning as well. So we might want to know what a customer's score is based on their Christmas spend or their January spend or their March spend. They might be very different, and we might need different models for that. So I expect to see more transactional scoring going forward. And that's it. Thank you very much. I think, do we go to questions? Any questions?
Okay, so anyone who has questions for, first of all, let's have a round of applause to Mr. Thomas, please. A round of applause. Thank you. So anyone with questions? AI-driven credit scoring and loan approval processes. Anyone with questions? Can we have a show of hands for anyone with questions? Thank you. 2, 3, 4. Anyone else? Questions? Questions? Anyone else? Okay, we'll start with the gentleman here.
Okay, thank you for a very nice presentation. And my question goes to our setup, especially in the African setting, Tanzania inclusive. We have seen some of these, the way we evaluate a client before we give them loans. But the challenge we have, most of our clients, most of the credit facilities, they are not registered into the credit scoring systems.
Yeah.
So at the end of the day, you may find out the client maybe have a very nice score, but unfortunately, it's because maybe there could be some loan obligations to facilities, but they are not included into the the credit scoring system. So one of the biggest challenge of how the system works is because very few financial institutions use the system, but majority, I can say more than 50% of the institution, they do offer loans. People do take loans in several places, but nowhere you can trace this. So I would like to know what will be the best alternative or strategies so that we can at least take a measure to at least minimize or identify people who have been, who are not seen anywhere among the financial institutions that have been registered into the system. So thank you.
Thank you very much for your question. I'm going to answer it in two. Okay.
So we'll take all the questions and then you answer them one by one. We had another question here. Here, right here.
Hi.
Hi there.
Very nice presentation. I have a risk management and data science background. It was very interesting for me. I have one question about this judgmental situation, scorecard or whatever you're calling it, yeah? Also, let's say in UK it's very popular, this psychological testing with the pictures, for example, yeah? I've been working in Nordic countries, it's here. But how it can be implemented in Africa, given that people here, they don't know what it is, and let's say if I would live in some village, and suddenly I'm applying for the loan and see some, pictures, yeah, I would probably think that this is a fraud or somehow, probably this will somehow impact sales. So what is your experience in Africa?
Okay.
Thank you. I believe we had another question. Oh, there.
Thank you. Thank you, Mr. Thomas. I just want to concur with what the lady has actually stated there, because this is a new technology in regard to all-driven credit scoring and loan approval processes. It is actually a brilliant technology pretending to the people to actually have an access to get loans, such kind of stuff. And in Africa, how far would you actually be able to implement this? Because we need different stakeholders, like, for example, the smallholder farmers. We need them to grow, improve varieties of crops, and they have problems in terms of inputs. How are you going to actually help such kind of people so that they can grow enough varieties of crops in order to combat hunger? And in addition to that, we have students who actually sometimes have got problems in terms of school fees, tuitions, and the like, How are you going to actually help such kind of people? And we have a number of people who are vulnerable, poor. They need to have access to such kind of loans so as they can be able to conduct themselves in SMEs, entrepreneurship programs. How are you going to actually try to help such kind of majority of people? Because what we need is to combat poverty. Poverty is caused by 3 causative agents: hunger, diseases, and ignorance or illiteracy. So our main concern is to combat these things. So through that, it can actually help. So how are you going to assist Africa in terms of that? Thank you so much.
Thank you. Did we have another question before I go to Mr. Thomas for the answers? Okay, we'll start with those. Mr. Thomas, please. Should I remind you of the questions, or you have them all?
I think I've got them.
Okay.
I just want to thank you all for really great questions. I'm very happy to answer them. Okay, so so the issue, there's 2 parts to that gentleman's first question. The first is we've worked with many companies. I think we work in over 30 countries, but I've worked in about 15 of them around the state of the credit bureaus. Lenders must look to come together to put together bodies that insist on a reciprocal nature of sharing data, performance data, and then having access to that performance data. Until that happens, it's going to be a very difficult time we're going to have with a lot of people. When I started my career, we didn't have reciprocal nature. There were certain bureaus had some information, other bureaus had another, some people weren't applying, but we had a regulator and a National Credit Act that made it insisted that there would be lenders had to give data to the bureau, and lenders had to check the bureaus at every step. Nevertheless, today in South Africa, we have a population of 61 million people. It's estimated that 18 million people are financially excluded. So this is probably answering two questions at once. 18, and so our goal is, and this is the goal of the World Bank, we work with the World Bank as well, our goal is to try and address this by offering alternative data scoring, for example, psychometrics, where we can give a test to a customer, and we've done an analysis, rural, urban, people score in the same way on the psychometric side of things. I'll get back to that question just now, but alternative data is going to be a big step in terms of in bringing about lending to all different walks of life and going down the road of financial inclusion. So that's very, very important. And in terms of how well this test works, we are using the test for unsecured lender, specialist lending, banking, microfinance, even insurance as well. And why it works for all of those areas is it picks up a customer's, essentially, I don't want to use a word, I can't think of the right word, but deviant personality. If a customer has more of a deviant personality, then they are a higher risk. And that's what we look to when we are running these tests. And that means those customers are more likely to commit fraud, and on an insurance policy, they're more likely to stop paying their loans, and they're more likely to also not conduct their business in a good way, a good manner as well. And not to mention, so alternative data, this is one area of alternative data. Another area is entrepreneurial scoring. So we talked about it, that third question at the back. We also have an entrepreneurial score which tests a customer, a business owner's business acumen. So do they understand key issues around how to deal with employees, with how to deal with stock challenges, with how to deal with cash flow issues? And we ask a question, I think there's 15 questions we ask, and from that we generate an entrepreneurial score. So we actually utilize the entrepreneurial score, which is also alternative data, with the psychometric score together to help make better decisions for people, whether they are farmers, whether they are street vendors, whether they are people with larger businesses as well. Okay, so I think, let me just check if I've wrote some notes here. So, yes, and on the matter of psychometrics, the questions that we offer, they can get, those pictures that we had, they can get interpreted differently by different people. In fact, any one of you sit with me and we go through the questions. Some of them you will interpret slightly different to another person, but that's fine. That's also comes into scoring as well. And so we generally find there are certain choices that people make which relates to bad traits, and that is pretty consistent whether you are in a township and you're functionally illiterate, or whether you are well educated living in an urban environment, or whatever combination of the above. So I hope that's answered some of those questions. Yeah, so sorry, the other question around, yes, we build scorecards for all sorts of different types of products, so that scorecards can help educational loans. But educational loans, we typically will be building scorecards not for the student necessarily, but for the person who's going to be paying the bills. That's who we generally score. And then different types of loans may have different scorecards in the SME space. Are you growing a business? Are you starting a business? Are you wanting to Is it working capital you're after? Is it venture capital? Is it a vehicle and asset finance you're after? All of those sorts of different reasons for lending might have different loans, because the risks for different for each of those loans might be quite different to the next.